David, how does that play out in the sense that Russia is, it's a big oil producer and it's been hit hard. In fact, it's been hit harder by the decline in oil prices, arguably, than the sanctions thus far, although they're not unlinked. If you had a very big stepping up of economic sanctions, would you expect Russia to counteract, perhaps on the gas side or something like that? And how would you, as an investor, think about this in terms of gaming through what was likely to happen?
Well, I guess you could go long gas in Europe, which is very sensitive to their dependence on Russian gas. But I think Russia is one of the largest oil producers. Most people think of Saudi Arabia and the Middle Eastern states, but Russia's the largest, and 40% of its government revenues are from oil. So it's quite ironic to me that there's so many actions by the State Department and very conscious, deliberated foreign policy. Yet I think the greatest economic impact on some of the countries that we've placed sanctions on, like Russia and Iran, has been the result of private capital deployed in private lands, and maybe the drill bit's mightier than the sword in that case, because it's created a lot of pressure on those countries. In terms of how to play it, I guess one way we've played it to date is not investing in Russia, and we like to invest overseas. Almost half of the dollars we've invested in energy, and I've been at Blackstone for 20 years and in charge of the energy business for about over a decade. We haven't found something that we felt comfortable with in Russia. So we do like investing in countries where there's a perception of high risk, but they're moving in the right direction. And with OPEC now not functioning as a cartel, choosing to step back, without that shock absorber for global oil prices that really stabilized things when sanctions were first placed on Iran and their capacity was taken off the market. Saudi increased production to keep it from going too high. In the past, during the global financial crisis, they took some production off. That stabilizer's not there, so the market for oil is going to be more volatile. And that generally, if you have something that's more volatile, it reduces the amount of investment, and it certainly increases the cost. And that's what we've seen in the U.S. and we've seen it around the globe. So I think it makes us more excited to invest globally in energy. It also puts a premium on being very particular and picking the countries that you invest in and the management teams that you back.
Well, we'll get on to the places where you will invest in a second, but just thinking, so you think differently about Russia. Do you think differently about Eastern Europe, about the peripheries around Russia because of this? How far does the impact of geopolitical uncertainty go in affecting your decisions there?
Well, everywhere, because an event and I was struck by, as you listed through all the various conflict areas, many of them are significant oil exporters. And that price is telegraphed around the world instantly. So it's not just one country's impact, it's a global impact. And while I think we can be reasonably good at the below-ground analysis and looking at things on a micro level, it's virtually impossible to predict the next, like Libya, which went off.
Except right now, it hasn't really been telegraphed, right? Because, as you say, because of shale and because of Saudi Arabia's action. So the fact that Nigeria is a big oil exporter, the fact that Libya is an oil exporter, a lot of these countries are oil exporters. And if you'd said to me a year and a half ago, you're going to have these countries, with sort of jihadis and with potentially breaking up and huge sort of geopolitical instability, and yet the oil price is going to be where it is, I would have laughed at you.
It's surprising, isn't it? And in the summer, the reason why oil spiked up above 110 was ISIS was moving and people weren't sure where they were going to go north or for the east.
Okay, I'm going to open to questions in a second, but before, I'm just a bit too depressed right now. So I want, David, I'm going to ask you an upbeat question, which is, tell me a country that you look at where, in fact, the threat is not as big as people think it is. There must be one somewhere.
Sure. I think a little closer to home, maybe Mexico. We share a huge border with Mexico, and I think while 75 years ago it was a bit of a threat when they expropriated the oil industry, now they're I think under reformist and very thoughtfully minded leadership, they are reopening their energy economy to foreign direct investment, and I think everything I've seen from Peña and Emilio Lozoya is that they have the best interests of their citizens at heart. I think they're moving in the right direction, and they'll be a beneficiary based on those policies of global capital flows. We can invest anywhere in the world we want or just at home. And I think that's true for most of the non-state affiliated oil company capital. And so countries that are moving in the right direction, demonstrating rule of law, and welcoming foreign direct investment will receive it. And the oil industry is very capital intensive, so the capital has to come first before you can get the oil to flow. Other countries, have not reliably, they welcome you in, but then the deal changes and you can't get out. And then I think many countries, I think Africa is on the cusp, or some countries headed in the right direction, perhaps some falling back the other way. And since we're a private equity fund, we're not a hedge fund, and as a practical import, what that means is we're not making liquid investments. So if we invest a few dollars, we can't change our mind the next week if foreign policy changes and get it out. So we really need to have confidence in the government that's moving in the right direction. We love to find opportunities where the country's perception perhaps is negative and lagging, but we believe from our due diligence and from the people that we've met with that it's headed in the right direction.
So Mexico, what about, but none in the broader Middle East, presumably?
I think we talked a bit about Kurdistan, and I think they're not in control of their own destiny, but I think if they were, I believe they're headed in the right direction. And in an environment where oil may be a bit lower priced for a few years, it helps to have low-cost reserves, and they can actually make it up on volume because they're starting from such a low base. So they can increase production quite a bit, increase revenues, and if you believe that over time, perhaps you don't know how the revenue will be shared between they and Baghdad and others, but you have confidence that the oil is very low cost. It's needed by the world economy. It'll be produced. Having a chip on the table there could make sense. North Africa has a range of countries. I think Morocco has a very stable leadership. One of the companies that we're an investor in is drilling a very large, hopefully very large, offshore well in Morocco, and we have a lot of confidence in that country's ability to manage that oil reserves should we discover some. Egypt's had a relatively difficult period, but they're also a hydrocarbon-rich economy that desperately needs more, particularly natural gas, for domestic consumption. So these are all countries that are either in or borderline some of the troubles that you mentioned. Mm-hmm. But I think if you pick your locations carefully, you could do well economically and also do well for the country, for the people in the country, because these revenues are used to support the citizens of the country, to facilitate economic growth. And economic growth, I think, over the long term leads to more stability. People who don't have a bright near-term future in terms of education, jobs, and income per capita can turn to things like ISIS. So I think having a bit more stable government and them deploying the revenues from oil production
that's the hope, right? That's the very positive.
Not many countries have been able to do it, but the ones that have really benefited their citizens.
Let's now open to questions, and then Todd, I'll come back to you. Questions. Let's start at the back there. Lady right at the back. Gentleman right at the back. I'm sorry, I haven't got my glasses on.
Sorry for Mr. Foley. Well, do you anticipate a slowdown in the investment in midstream facilities, natural gas, liquids transport facilities, and LNG export terminals that are necessary over the longer term to keep U.S. gas from remaining stranded from world markets? I mean, because of the price risk and because of the increased counterparty risk from lower credit quality E&Ps.
Sure. So your question, I think, is focused on U.S.-based export facilities, because obviously there are LNG facilities around the world. Well, we have the benefit of having already made an investment in the facility. It'll be the first in the lower 48 to export, Cheniere's Sabine Pass facility. And so we're definitely a believer in the potential for exports of liquefied natural gas from the United States. We're also upstream investors. We own natural gas reserves in the U.S., and we believe there's an awful lot of it that will be available for a very long time at a very cost-effective price. So by exporting, we're not going to raise domestic prices at home. We think this pretty flat supply curve will just be able to export quite a bit more. And I think the good news is that before this event, which lowered oil prices, a number of these projects were approved. And I think this is an example maybe where the U.S. government has moved along in a reasonably timely manner. The FERC working together with the DOE to approve these export facilities. It's not like the Keystone Pipeline, which is still 6-7 years later. A yes or a no would be nice. So they've actually done pretty well. So I believe those, there are a number of projects that have already received approval that have long-term commitments. Like with Cheniere, we have 20-year take-or-pay commitments from high-quality investment-grade multinational companies. And so that construction's on track, on budget, and a few of the other projects as well. So I think we'll have at least 8 to 10 BCF a day, billion cubic feet a day of exports in the next 5-6 years. It takes a while to build it. We've got a 2-year head start, but and our facility should come online within 12 months or so. It'll start to come online. So I think if this was happening 4 years ago, it might have killed it, right? Because natural gas prices globally, they're not linked here in the U.S., but globally they're linked on a formula basis to crude. 14-15% of the crude price. In Japan, that's what they're buying LNG at. And so this downturn in crude oil prices is mathematically also a 50% decline in gas prices in many countries that are on the receiving end of these exports. So I do think you'll have a bit of a hiccup for projects that haven't yet achieved, a final investment decision. They don't have shovels in the ground because the consuming countries, may think a little bit about it. But fundamentally, Southeast Asian countries in particular, and also you mentioned Zenny, European countries, it's not just about price, it's about diversity and security of supply. No one wants the lights to go out, and when you have events, like in Japan where they had the nuclear accident, it kind of highlights the importance of having diversity of supply. So I think it's very important for countries in Southeast Asia and Europe to have access to U.S. natural gas, which can be priced not off the global oil price, but off Henry Hub, and it's not coming from Russia. I think that's in their best long-term interests, and they're making long-term decisions. The price of oil, was 100, now it's 50. Who knows what it is 5 or 10 years from now? It's probably going to be more than 50. And these countries need access to politically stable sources of natural gas, and we can provide it.
Todd, given what you were saying about oil production markets running at nearly full capacity, do you think people who are counting on the low oil price persisting into the future are maybe underestimating the potential for a geopolitical blow-up somewhere in the world and therefore for the price to quickly rebound?
Yeah, I think it might take, my own views might take a little longer. We've had kind of a little bit of a pop here, which seems to have been short covering, but there's still excess supply, and if we run on floating storage, you could test new bottoms, and price is a result of supply and demand. So demand's been kind of anemic globally, and Europe disappointed. It's not even supposed to grow, but at least it shouldn't shrink, and it did shrink a little bit. And the engine of China just still going, but was slower, and that's that disappointing demand coupled with OPEC not performing the function it had in the past was enough with just a couple million barrels or so of excess supply. We have an inelastic product for the price to drop quite a bit. But I do think if you look at an analog of natural gas production in the U.S., where we had rig count, the rig count now is like 250 rigs for gas in the U.S., and 3 years ago it was 650, and last time I checked, we're producing a lot more gas in the U.S. And one of the reasons is that when prices go down, obviously the cash available to spend in CapEx in a kind of a market and not a state-sponsored company goes down, but then they just focus on the most productive wells. And there's a very wide dispersion of break-even costs of shale oil in the U.S. And so a 30% reduction in CapEx doesn't mean a 30% reduction in oil production. It means, one, the service companies are going to have to lay off a lot of people and lower their prices, so that actually lowers the break-even costs, and the companies will focus on the most productive wells. So I think for those reasons, and the fact that demand's reasonably anemic, I think that absent any one of the 10 countries you mentioned that could have a blow up and stop exporting, absent something like that happening, I think it'll take a little while for supply to start to self-correct, because there is a decline rate, and it is a pretty robust self-correction mechanism. Decline rate's probably triple what demand growth is, and for demand to grow.
Before we conclude, I want to put you a little bit on the spot, the two of you on oil and you on Putin. On oil, you both talked briefly, you talked about where you thought the oil price was going in the short term. Look out a little bit further, and in 5 years, what is, give or take broadly, where is the oil price, and what is US production? If we had our cover of Shakes v. Shale in 5 years' time, are the Shakes winning or the Shale?
I'd probably be a little more bullish than that, in part because I don't think 5 years from now U.S. production is going to be higher than it is now. I don't think, unlike natural gas, where there's many more deposits of shale in the U.S. that are commercial for gas. And if you think about it really simply, it's easier to push something that's in gaseous form through solid rock than it is something that's a liquid, particularly a viscous liquid. There's just fewer areas where you've got exactly the perfect porosity, permeability, where you can actually do that. And so we don't have a 100+ year supply of shale oil. Haven't seen anything that would make me believe that. So I think, and we're also very commercial about running through it quickly. So I think you'll have U.S. production 5 years from now being a little bit lower than it is today. I think the oil price will be, Brent oil, let's talk, because WTI is different from Brent. I'm a little more bullish. I think it'll be north of 80, actually, because it's in U.S. dollars, so the dollar's been really strong. That's made it expensive for other countries to buy oil. And I'm a believer over that period of time in global economic growth, and global economic growth in non-OECD countries. If you look at the last decade, there's been no growth in the OECD from petroleum consumption, zero. All the growth's been outside the OECD. So over time, the market share of demand, because we talk about market share of supply, but the market share of demand has shifted, and for the first time, actually, in the last few years, more than 50% of global petroleum consumption has come from non-OECD. So the fact that the US and Europe and Japan aren't growing is every year less and less relevant for the petroleum price. And I do think 5 years is more than enough time for supply to self-correct, for the 4-ish+ % annual decline rates from existing production to happen, and all the big, expensive, long lead time projects that would have been happening right now, that just got canceled, that take years to put back together, won't be coming online in 2019 and 2020. So if you add that into the mix, and if one of the 10 countries you talked about, just 1 in 10 over the next 5 years, blows something up that can't be quickly fixed and put back online, you'll have oil back over 80.
Thank you. That's fascinating.